I'm sure you've always been told that investment properties will be the best investment decision you make in your life. But what if I told you that the annual inflation adjusted net profit for an investment property in Australia is 0.74%? If you stick to the end of this video, I will show you a financial instrument that has inflation adjusted annual returns that are 10 times higher than the average investment property in Australia. And just a quick disclaimer, these numbers that I've said, I haven't just pulled out of my ass for dramatic effect. There will be a full mathematical breakdown of all these real statistical figures and real world data shortly. So if you've clicked on this video, I'm sure you've thought of buying an investment property either now or in the near future. For your investing mindset, I do want to commend you. However, I'm here to tell you that the world of investment properties was rigged against you before you even knew what a dollar was. Now, I'm sure if the topic of finance or investment ever came up at your dinner table, for example, people always told you to buy an investment property even though they didn't own one themselves. And in theory, it sounds great, right? Living like you're in the Monopoly, sitting back, relaxing, and watching your passive income grow. The harsh reality is that this is only the case for about 1% of property investors, and the other 99% usually tend to lose money. This is why the game Monopoly is called Monopoly, because it's a monopolistic market. Everything is owned by the top 1% or the top one player, and everyone else loses. Another thing with Monopoly is that the game doesn't take into consideration taxes or fees or commissions that you have to pay when you do own an investment property. So let's consider all of these factors and see how much you would actually make if you had an investment property. Okay, so let's start with how much we expect our investment properties to grow annually. According to CoreLogic, the average annual growth rate over the last 30 years for an investment property is 5.4%. Now, this number isn't adjusted for inflation. So to adjust for inflation, I'll use this formula and I'll assume that the inflation rate is 2.5%, which is in the middle of the 2 to 3% target that the RBA sets. And plugging these values in, we get an inflation adjusted annual return of 0.283 or 2.83%. Okay, so now we have an accurate figure of how much our property is expected to grow. Let's find out how much we would expect to pay for our property. Now, because the average annual growth rate that we just calculated was from 1992 to 2022, I'll use the average house price in Australia for 2022. And according to the March 2022 house pricing report from Domain, the average house price was $1,069,289. Now, obviously, you're not going to just hold your investment property for a year. You're probably going to hold it for roughly 30 years or however long your home loan is. I'm just assuming 30 years because that's how long these home loans usually are. So in 30 years time, our property will grow to $2,469,961.44. This leaves us with a gross profit of $1,400,672.44. All right, so now that we have an accurate figure of how much our property will be worth in 30 years time, let's look at the fees, commissions, and taxes. The biggest tax you will pay will be your capital gains tax, which is tax you pay on an asset when you sell it. And since we've held this property for more than a year, we are eligible for a 50% discount for our capital gains tax. So our taxable figure will be 50% of our profit, which equates to $700,336.22. This amount puts us in the highest tax bracket, which is 47%, which also includes the 2% Medicare levy. So 47% of $700,336.22 is $329,158.02. So this is how much you would pay in capital gains tax. So now our current profits stand at $1,071,514.42. Alright, now let's move on to land tax, which is an annual payment. And for this, I will be using this table here. So since our property is valued between 1 million and 1.8 million, we'll pay $4,650 plus 0.9% on the amount that is over 1 million. So plugging this in the calculator, we get $5,273.60 in a year. So now to find out how much we would pay in 30 years time, including the inflation adjustments, I will use the future value of an annuity formula. So plugging these numbers into the calculator, we get $231,525.34 that we have to pay for land tax. And now our profits are $839,989.08. Next up is home insurance, and according to iSelect, the average Australian pays $1,177 a year on home insurance. Now to find out how much we pay in 30 years time, that's also inflation adjusted, I'll use the same future value of an annuity formula, and plugging in the values we get $51,673.48 that we have to pay in home insurance. So now our profits are $788,315.60. Next up is maintenance, which includes things like council rates, your bills, your mortgage repayments, and any property management fees you might have. The general rule of thumb is to have around 1% of your property value, so you can spend that on maintenance. So in our case, 1% would be $10,692.89. And over 30 years, inflation adjusted with the same future value formula, this would be $469,446.78. Now our profits are $318,868.82. And thank God, our final fee that we have to pay is the real estate agent fee that these agents take as a commission to sell your house. According to realestate.com.au, this fee is between 2 to 2.5%. So we'll just use the average of 2.25%. So 2.25% of our selling price is $55,574.13. And drum roll please, our final net profit is $263,294.69. So we went from a gross profit of 1.4 million all the way down to a net profit of around $250,000. So now you can probably see why an investment property isn't the best decision you can make. So what is this profit that we made as a percentage increase of our initial investment? So if you remember, our initial investment was $1,069,289. To find the percentage change, I'll just use this formula here. Plugging these values into the calculator, we get 24.62% over 30 years. Now to find the annual growth rate that I mentioned at the start of the video, we'll use the compound annual growth rate formula. And plugging in these values, we get 0.0074 or a measly 0.74% annual increase. So how shocking is that? You've probably expected your property to have doubled or tripled or quadrupled by that time, and you're expecting that every year you're making so much money, but in reality you're only making 0.74% on average. As I mentioned before, there are still that 1% of people where buying an investment property is the best move for them. So who are these people? So these are the people who basically have access to unlimited capital, and they don't need a mortgage from the bank, and they can just buy these properties out front, which means that they are automatically positively geared. And positively geared just means that all the money that they receive from rent, instead of going out and paying that rent money towards your mortgage, it just goes directly into their pockets. So because they have access to an unlimited amount of money, they can stack up multiple properties, and this 0.74% figure would just grow to however many properties they own. Kind of like the Monopoly, right? The player that wins. Say for example that you buy a massive plot of land in a very underdeveloped area because you hear news that later down the line this area will be very well developed. They'll have a big shopping center, they'll have a massive train station, they'll have public transport, and they'll have a bunch more houses in the area. So you think, all right, this is a good idea. I'll buy a massive plot of land and I'll subdivide it into 10 smaller plots. So now you build 10 investment properties, and you can see how quickly this 0.74% figure would jump. It would go from 0.74% annually to 7.4%. Investment properties would also make sense for people who have already bought their first home, because obviously buying a home is the biggest financial expense of your life. So imagine before you even buy your first home, you fall into this trap of buying an investment property and you make a lot less than you realize, and now all of a sudden you need to start from scratch again to save for your family home. And this would take 5-10 more years of your precious life. But if you already have your home and you do want to expand on your investments, I can see why it would work. But I still believe that there are an enormous amount of financial instruments that you could invest in instead that would give you tenfold the profit. So make sure you stay tuned so you can save yourself years of your life. So if you are this 1% of people, this is a pretty good move, but it's not your best move. It's a pretty good move because these figures that I've just used were actually biased, and this last 30-year period that we've gathered all this data from was actually an outlier period. Now, before you write in the comments some hate, it's an outlier, but not for the right reasons, for the wrong reasons. You see, according to many economists around the world, they consider Australia's housing market as the biggest financial bubble in the history of time. This past 30-year period that I've gotten my data from was considered a once-in-a-lifetime boom period for these houses. So in simple terms, this just means that this was the best case possible. So why are we in this boom period? Well, there's two reasons. The first reason is because of the mortgage interest rates. Now, before this 30-year period, around the 80s, the mortgage interest rate was around 18%. When I saw that figure, I could not believe it. I could not believe it. In the 90s, at the start, it was around 17%, and then it stabilized itself to around 10%, and now this figure is around 6%, according to CommBank. And the second reason is Australia has some of the highest household debt in the world. So because our households are borrowing more, and because borrowing is becoming cheaper, the demand for houses is rising faster than the supply of houses. So this causes a supply issue, obviously, and it causes the sellers or owners of these houses to sell these houses to people like us for a ridiculous inflated price. And year by year, these prices are slowly increasing and becoming more inflated, and it's just becoming ridiculously hard for people like you and I to actually afford one of these houses. So even in a boom period, the average annual return, inflation adjusted for an investment property, is 0.74%. Imagine how terrible this return would be in a bust period. So what is this elusive financial instrument that I'm talking about that will tenfold your investment and will be the equivalent of having 10 investment properties? It's the S&P 500. So what is the S&P 500? The S&P 500 is a stock market tracking index fund that tracks the top 500 performing companies in the United States of America. So in simple terms, this just means that someone who is a lot smarter than you and I is tracking the top 500 performing companies in America while circulating out the poor performing companies and replacing them for the trendy growing companies, while still keeping these giants like Apple, Tesla, Nvidia, Microsoft, Google. And these 500 stocks also change in weight. So for example, if one year the technology industry is booming, then the index fund will automatically allocate more of its resources or more of your money towards the technology industry and less than everything else, so you can maximize your returns. So it's basically just a very well diversified portfolio that you just have to buy, and someone who's a lot smarter than you and I does all the work for you. So let's get into the mathematics of this. What is our return? How much can we expect if we invest the same amount? And how much better off are we investing in the S&P 500 compared to buying an investment property? On average, according to backtest by Curvo, the S&P 500 has achieved an annual growth rate of 10.68% in the last 32 years. This 10.68 figure is for the US dollar because the S&P 500 is obviously an American index fund. But don't worry, I've converted everything in the full breakdown that we're about to do. So to adjust this 10.68 figure for inflation, I'll use the same formula that I used before, and plugging in the values, we get 0.0798 or 7.98% annual returns. But what about fees and commissions? This is where the S&P 500 shines, because you only pay a fee for buying the S&P 500, selling the S&P 500, and then capital gains tax on your profits. So let's just say, for simplicity's sake, we buy $1 million worth of the S&P 500 on stake, and this would charge me $7,000 in fees, and would therefore give me $615,000 to invest. And just as before, we'll see how much this amount grows to adjusted for inflation. So we'll use the same formula, and plugging the values in, we get a whopping $6,154,245.40. US dollars, by the way, not Australian dollars. And this is over a 30-year period. So once you sell the S&P 500, you will pay a selling fee, which is 0.01%, which in our case would be $615.42, also in US dollars. And then to convert from US dollars to Australian dollars, we'll pay a foreign exchange currency fee, which would be $43,079.72, again in US dollars. So we are left with a profit of $6,110,550.26 in US dollars, which would convert to $9,821,426.33 in the Australian currency. Now for the third and last thing that we have to pay is capital gains tax. And because we hold our investment for more than a year, we also get the same 50% capital gains discount, and therefore our taxable amount is $4,910,713.17. This would also put us in the highest tax bracket, which is 47%, including Medicare levy, and we would be taxed $2,308,035.19, and therefore we would be left with a net inflation adjusted profit of $7,513,391.14. So this is like 5 times our gross profit of what we would have got with an investment property. So as a percent of our initial investment, which was $1 million, this would be a whopping 751.34% increase over the 30-year period. And to find the annual rate, we'll use the same compound annual growth rate formula. And plugging in the values, we get an enormous 0.074 or 7.4%, which is coincidentally 10 times the amount we would have received from an investment property, which is kind of crazy to think about. Like, all these numbers were completely random and average from the internet, and we get exactly 10 times. Just as a quick side note, if you want a full guide on how to buy shares or index funds like the S&P 500 that I've just mentioned, I have made a full guide that I'll have linked somewhere here that you can watch. Now, if your brain is switched on, you'll probably be thinking to yourself, what about leverage? Since banks typically let you borrow a lot more for something like housing compared to something like shares, your investment property will have a lot more leverage than the S&P 500 investment you make. However, you must realize that with leverage comes risk. So yeah, you can make 30 times your profit, but you can also lose 30 times your money. And for the average Australian, that's a lot of money, and money that we probably can't afford to lose. But if you are a risk taker, then yeah, leverage is the best option for you. But you can also leverage your position on the S&P 500. So any profits you make could be 30 times what you would have originally made, but then at the same time, any losses you make will also be 30 times more. This is something that I obviously don't recommend, but if you wanted to do so, all you would have to do is just find a futures broker in Australia and invest through them. The max leverage in Australia that brokers can offer anyway is 30 times. So that's why I'm saying this 30x figure. So you would just open a long position on the S&P 500 and it'll be automatically leveraged to 30x. So if you are a risk taker, this could be a viable option for you, but I would just encourage you to do the right amount of research. Find the best broker that offers the lowest fees and is also the most reputable. So to conclude this video, I hope that the numbers speak for themselves. While investment properties do have its place if you have a ton of capital or if you've already bought your first home, for the average Australian like you and I, your best move would be by far investing in the S&P 500. It would be the equivalent of you buying 10 investment properties, but minus the smoking tenant, minus the regular cleaning visits, minus the maintenance hassle, and minus the overall headache. The S&P 500 is simple, reliable, offers long-term growth, and ultimately hard to beat.